All right, what up, everybody? This is Jeremy with Escape Velocity Trading coming at you for a market bias update report for Tuesday, September 2nd, and the remaining part of the week ahead. I've been radio silent for the last couple of weeks, just got back from a 2.5 week road trip with my wife and had a great time, but I am back to the markets now and ready to buckle down and analyze the markets and charts ahead to help you with your trading. So, diving into the charts, there has been quite a bit for me to update myself on after being unplugged for the last couple of weeks here, but not much has actually changed in the price chart itself. So, starting off with the SPY, if we zoom in here a little bit, you can see I have a couple of diagonal support lines drawn. One has just been violated with price action today, gapping down on the open, pushing all the way down almost to our second diagonal support and fighting right back up into basically our 20 SMA, our simple moving average right here in blue. So looking at the chart, right now we are still kind of in a choppy zone. If I get my drawing tool, we are in kind of a choppy zone with horizontal support and diagonal support kind of converging here between the 20 SMA and the 50 SMA in pink and upper end right here. So we have basically from 632 up to about 650 range, where anything staying in this range is going to have to be considered neutral. If we do break this lower diagonal and this lower horizontal, by that point in time, this 50 period moving average will likely have converged up until that point. So at that point, we will have three different types of support all forming right in that same price area around 632. What that means is a break of that level to the downside is going to be very, very significant because we're not just breaking one type of support, we are going to be potentially breaking three all at the same time there. So I am keeping my eye on that 632 support level for the S&P 500 very, very closely. And if we do break and get a daily close below that level, I am going to be interested in adding some shorts to my trading and getting a little bit of protection to hedge my overall portfolio. So, what happens if we don't break that? Well, if we don't break that, I am looking at that 650 level as our overhead resistance line. I am expecting that to continue to hold. Based on our RSI, if we look at the RSI here, we do have a little bit of bearish divergence where we are setting simultaneously lower pivot highs on our RSI while continuing to set slightly higher pivot highs on our price. So you can see here kind of setting a little bit of a diagonal upslope on our price while setting a simultaneous downslope on the RSI. That is known as bearish divergence. And in longer term uptrends, if we push this back out and I clear out our drawings so we can see price action a little bit clearer, that usually signals at least a longer period of consolidation, if not potentially a little bit of a shift in sentiment and maybe a little bit more bearishness on the short term. Now, we have to take this with a grain of salt because we have probably what is going to be the single most important Federal Reserve rate cut decision potentially coming up on the 17th of September, just 14 or 15 days away. And that is going to potentially set us up for price action for the rest of the year. So anything that we are talking about right now is going to be short term analysis just for the next week or two leading up until that decision. Once that decision is made, that is going to probably set my tone for the rest of the year. So be sure to check back on the video that I do after that rate decision has been finalized. But right now, I am seeing enough weakness here, and we have been overextended enough in this run for a long enough period of time that I am interested in seeing where support will form if that 632 level breaks. Looking at the chart, our obvious first target from horizontal perspective is going to be 620 and then coming down potentially to around 595 or 600. We have a little bit of a zone there, both from horizontal price action and from our moving average creeping up over time. Now, one last thing before we look at the next chart, putting this out to a weekly time frame, and I am going to shrink down our RSI that we already talked about, and I want to enlarge our MACD here. So on the MACD, this blue line is the MACD line, the moving average convergence and divergence line. And this yellow line is actually a slower moving average of the MACD line. And when you are looking at the MACD, we want to pay special attention to where the MACD rolls over and crosses below that yellow signal line. So that happened right here, right here, right here. Kind of had a little bit of a fake out here, but had an actual cross here. And we are starting to look like we might get a crossover right here. Now, why do I point that out? Going back and looking at what happened in the price chart, every time I drew one of these red lines where this cross happened, we had a blue line cross below the yellow line right here. What happened? Over the next 4, 5, 6, 7, 8 weeks, we had consolidation and bearish price action. Again, right here, crossed over, we had 4 or 5 weeks of bearish price action. Again, right here, price moved lower. Right here, had some consolidation and the market fought for a little while and then broke down and had a really big sell-off coming almost back down to the weekly 200 period moving average. And again, where price is right now, we are setting up what looks like is going to be another MACD cross of the signal line. So this is one more piece to the puzzle where if that 632 level breaks, which actually also correlates almost to the dollar with our weekly 9 EMA, this green line. So if price gets below that green 9 EMA and that 632 level, and this blue line on the MACD crosses below the MACD signal line, that is my signal right there to start adding a lot more bearish exposure to the marketplace. I've already started to scale in with some option plays in certain areas of the market, but that is going to be the point where I start to short the S&P 500 directly or the Nasdaq directly and look for price to come down either to the rising weekly 20 at 609, or if we drop back to the daily chart and look at this one more time, again, there's also that horizontal support around 619 or 620. Now, taking the same analysis, going out to the triple Q, clearing off all of our drawings so we can see this a little bit more clearly and getting our RSI back. Again, we can see that bearish divergence in our RSI that we talked about already. We can see that we have broken down below our short-term moving averages, the 9 and 20 in the green and blue lines here respectively. And we are sitting currently at that 50 period SMA. So if that SMA breaks and we close lower, that is going to be signaling to me that bears are coming back and in control for the short term between now and that Federal Reserve announcement again on the 17th of this month. And then looking out to our weekly chart, again on the Nasdaq, we are actually front running the S&P a little bit, and we just actually have already set a cross of our MACD line and that signal line, signaling that more downside price action is likely to come. Again, last time we saw that, let me put on my vertical line right here. Last time we saw that was right here, had a little bit of consolidation and then a big breakdown. Going out next was right here, and right here. So what does every one of these vertical lines show us? It shows us that very shortly after or right when that MACD line crosses over, we ended up having consolidation and bearish action. Now, this doesn't mean we're going into a bearish downtrend because on the longer time frame right here, this was really just consolidation for a short bit before breaking out of that channel and moving higher again. But this is a big enough move to the downside that we want to protect our account. We want to profit from that downside price action so that we have more trading capital to then put into the market for the next big run higher. And that is exactly what I am looking at here. When we start to break down on the Nasdaq and the S&P, I'm going to be looking at shorting those opportunities back down into known support levels. And then once a bottom has formed, once a bottom pattern has formed, putting that money that I've made on the short side to work for the next bullish run. Going out to IWM. IWM, let's drop this back to a daily chart and take a look. Right now, we have a couple of different diagonals, one longer term right here and one shorter term. And we are basically sitting at the shorter term right here. We have maybe one more day's worth of price action until that is actually threatened. If we put this out to a 1 year chart, you can see that we haven't made it back up to the all-time high here yet at $245. I honestly don't think we are going to. I think it is more likely that we probably come back down and test that 220 level before we actually come up and test that all-time high. So I am looking at this as more likely to roll over and come back down into that 220 level than test that all-time high in the short term between now and that rate cut on the 17th. All right. Now looking at the Dow Jones, we have set a new all-time high here and actually had a really nice, powerful breakout about a week ago of a little pattern here. We had nice horizontal resistance at that all-time high previous level, broke out, but then had no follow through whatsoever with it. We broke out, and if we zoom in really tight on that, we had almost a week and actually a little over a week of price action that was totally contained within that one breakout candle. We had 5 days plus today's on Tuesday that wicked below it, but has the body of the candle completely contained and closed again in the side that body's candle. So to me, I am going to be waiting until price closes outside of the range of this breakout candle as my signal. If we do break out and close above it, I might be interested in playing to the bullish side, but honestly, probably not because I am seeing too many bearish warning signs in the market. However, if we cross below and close below that level, I will be interested again in adding some bearish positions to this chart and to my overall portfolio. We will have our diagonal support lining up pretty well with that 50-period daily SMA. And again, just to check real briefly, if we dive in to the weekly chart and look at this, clear out my drawings real quick and check this out. We do have our RSI starting to slow in momentum and showing a little bit of bearish divergence when the price action set a new high over that same time frame. And our weekly MACD has not crossed yet, but is slowing in momentum. So I'm not as interested in shorting the Dow Jones as the rest of the market. I think my preference right now is probably the S&P and QQQ equal, both on kind of a equal playing field for potential shorts. And then IWM interested in shorting, but not more so than the other two. And then the Dow Jones really not interested in shorting at all right now. Part of that is because a lot of the big blue chip stock dividend paying stocks are in that Dow Jones area. So think Coca-Cola and Pepsi, GE, Ford, those kind of companies. And when the market starts to, pardon my French, shit the bed, investors want to go towards companies that pay big dividends so they can at least profit from that while the market volatility shakes itself out. So I'm not going to be interested really in shorting the Dow Jones, but I am very interested in shorts potentially on the SPY and QQQ. Now, that wraps up our four main indexes. Let's pop out and take a quick look at where Bitcoin is. This is IBIT, the Bitcoin ETF that I track here at Escape Velocity Trading. If we clear out our drawings and take a quick look at the daily chart here, we are in some pretty significant consolidation on Bitcoin. The Bitcoin price currently on actual spot Bitcoin is just around 111,000. We have pulled back on Bitcoin about 10% from the high. I wouldn't be shocked to see us come down to 57, back down basically to our horizontal support zone here at 57 and also our rising 200 period moving average on the daily chart. And if we toss this out to a weekly time frame, we can see that our MACD did cross over 3 weeks ago, and we are in the process of exploring how low this wants to go. So I'm not going to be terribly surprised to see another leg down here. I don't think it's going to get out of control because I know that institutions are buying Bitcoin like crazy, but we do have a little bit of a new a new theme to be cautious of with Bitcoin, and that is that some longer term Bitcoin holders, some big whales in the marketplace, are actually starting to take profit on Bitcoin and are starting to roll their money into Ethereum, expecting Ethereum to outperform in the near future. So that is an interesting theme to be aware of. I am not rotating out of my long-term Bitcoin holdings. I am holding my Bitcoin positions because they are long-term positions. I am selling some covered calls on my ETF holdings, and I am also adding to my Ethereum position currently, enjoying the little bit of a dip that we've had in Ethereum to buy more of that. But I am not selling my Bitcoin because I do think eventually this resolves higher, and that is a long-term position for me. Now, finally, let's go out to our metals. This is gold, GLD, the ETF tracking gold. And you can see we have been consolidating ever since mid-April and just had a breakout with authority on Bitcoin, or excuse me, on gold. So now let's toss this out to a weekly chart, clean up our chart, get rid of our drawings, and you can see this is potentially the start of another fantastic run. The last couple of times we have had a horizontal resistance line or a diagonal resistance line break on gold, it has led to significant price appreciation. And I am expecting no differently here. Right now, we just broke out of the 318 level and we broke hard and have already run significantly, but I wouldn't be surprised to see this next party push up to around 350 or even maybe 360, depending on how much momentum it can get going into that Fed rate cut decision on the 17th. It's also interesting to note our MACD. So on the S&P 500 and the triple Qs, we were talking about where the blue line, the MACD line, crosses below the signal line, this yellow line, signaling bearishness. Well, right now we're getting the opposite on our MACD reading on gold, when the MACD line, the one in blue, crosses above the yellow signal line. That is considered a bullish signal. And we are getting that bullish signal right now on gold. And the last couple of times that we have had that happen, I will mark on the chart one more time to make very obvious. We had that happen here, 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 and here. We'll just say those for now. Scram up. So here we started that bullish run, although it was fairly mild until we got our second crossing here. We kind of had a little bit of consolidation, got our second cross, which was the real signal, big price appreciation. Next one, big price appreciation. Next one, big price appreciation. And again, we are at that level literally right now on gold, and I am expecting that history is going to repeat itself with another big move higher again into that 350 to 360 range. Once we get up to that 360 range, I will probably start to sell covered calls on my long-term position, but not before because I do think there is more price appreciation to come on gold. Now, going out to silver. Silver having a breakout of its own, and silver has been dormant and just kind of doing not much for a long time. And then all of a sudden last year started to wake up, and we have been enjoying a really nice price run on silver, almost doubling from the lows around $20 2 years ago up to 37. But to get a sense of where this might go, we need to put this on a max time frame monthly chart. And if we zoom in on that just a touch, you can see the all-time high is up here at $48.35. And we had some additional consolidation down here around $42.75. So really, those are my two price targets for this from a long-term perspective. I would not be surprised to see us end the year at the end of 2025 up here around 42.75 and then push higher from there into the around that $48 mark sometime early next year. That is kind of my price gauge for silver. And to me, silver usually goes through the same kind of thing where it has a long-term consolidation, choppy kind of mess. But once it breaks out with a lot of momentum. It moves really fast and way further than most people think that it can. So I have a feeling that we are right at the start of that and just maybe in the second or third inning of this move back up eventually to around $48. So I'm very interested in adding to silver positions as well. Last but not least for our charts, let's go out to look at the dollar. The dollar, there is nothing really to say about the dollar. It is just stuck in the mud down here on the daily chart. If we put it on a weekly chart, we do have a little bit of support forming here. Our MACD line has turned bullish. Our RSI is crossing out of that oversold territory. So I wouldn't be shocked to see us start to move higher a little bit here. I'm not going to be playing anything directly related to the dollar just because we have so much horizontal resistance up here around $100. And I don't want to play anything with that because we need to see a series of higher highs and higher lows before we can actually say this bearish downtrend has officially reversed and gone into a bullish uptrend. So I'm leaving this one alone, but it is interesting to keep an eye on because it does impact the rest of the market. Now let's go out to our heat map. This is a 1 week performance on finviz.com looking at the price movement from the last trading week. And we can see not much happening in a lot of our big tech names. Apple, Amazon, Microsoft, Google, Meta, not moving much at all last week. Nvidia was noteworthy. It had dropped 5%. And it's also interesting to see a lot of our utilities, real estate, and industrials starting to struggle really hard, and our financial data sector really starting to struggle. To me, looking at this overall, I see a really mixed bag, which leads me to believe that the momentum on the bullish side is dead for the time being, and we are either going to chop neutral or have a decent pullback here that will eventually lead to a nice buying opportunity. Last but not least, finally, let's go out to forexfactory.com looking at the economic data for the rest of the week. We do have basically something every day this week. Today was ISM manufacturing PMI data. Tomorrow's job openings, and then we go into the rest of the work with unemployment claims, services PMI, average hourly earnings, and unemployment rate again. So, looking at this, I'm not too worried about trading around any of these reports this week. I do get a little bit more hesitant to trade over some of the CPI and PPI data next week because that moved the market heavily last week. So, next week, I'm going to be cautious trading around these. This week, I don't see anything on here that is going to make me stay away from taking a trade when I see a good setup, and I won't probably worry too much about holding over any of these this week. So with that, guys, as always, let me know if you have any questions. Hit me up in the comments. Like and subscribe if you haven't already. Really helps me out. And now that I'm back from my vacation, I will be seeing you guys next week.